Well, I've been talking about the fact that maybe it was time to take a little money off the table. We talked about that cash is not always trash. Sometimes it's really, really nice to have some cash on the side that you can deploy if you see an opportunity, or if things deteriorate, you've got this extra cash as a buffer for yourself. I've been talking about the fact that trees don't grow to the sky, and we've had a very, very good run in the stock market. Now, at that point, we talked about the fact maybe you want to reallocate some of your money and take it out of one asset class and put it into another. And let's explore that a little further. And let me talk about why what we're seeing. Remember, we have a couple of charts and our models that are telling us what we think is going to happen, what is going to happen. Let's talk about why. We're talking about the fact you can see this bubble. Now, this is coming out of the Federal Reserve electronic data. It doesn't get much more authoritative than that. So this is actually coming right out of the Federal Reserve. And you can see this big bubble of liquidity that was put into the marketplaces. Now, this little gray bar talks about the recession we had. Now, that was a very short recession, but it was vicious and it was deep. And it affected virtually everybody. It did have some ramifications. So the government put out $6.3 trillion right here in the second quarter of 2020. And you can see all the reserves and all the bank deposits that got into the economy. And here they are. And now you can see as they get coming through and we're going in, the economy is starting to bubble again. And you're starting to see in 2021 they're being spent. Now, there wasn't any additional reserves put in. We didn't have any more stimulus. Now, you had a lot of stimulus. $6.3 trillion, let me tell you, is a lot of stimulus. And that was stimulated here. And of course, it got spent. And here we go back into 2021. And we start getting into a normal market. Now, you can see that they just did some more stimulus. And you can see it popped up just a little bit. Now, we're going to watch that. But this caused inflation. Look at all the money that came into the economy, and it changed things. Now, you've seen the labor. So if you were making $12 or $14 an hour before, well, you're not going to go back to making $14 when you get $20 an hour, because we've had labor shortages, and of course, inflation has now been ignited, and it's become a virtuous cycle. So we're starting to see that one cause causes another. So as prices go up at the producer price index, and we saw that coming a long time ago, and of course it races it through the whole chain, and we go back to a new reality. Once you start making $20 an hour, you're not going to go back to making $12. So that's just part of the new reality. So let's go to my next slide and let's discuss this even further. Now, we've been talking about the fact that you can see this bubble. Look at this big gigantic increase. Now, this is where we saw the PPIs come out, and we saw the PMIs came out. We're well over 60. Now, when you have a producer, when you have the Purchasing Managers Index, the PMI, when that's running around 52, 54, 55, it's a good world. Everything is doing well. It's above 50, means that the economy is expanding. And of course, it's expanding at a very sustainable rate. Now, this expanded at a rate that was not sustainable. It got up to 62, 63, 64, 20 or 30% more than what we normally see. And of course, it has slowed down. Now, it is slowing very, very slightly. It contracted actually 0.3%. Not much, but we're watching it. Now, my personal feeling is that this is going back to a more sustainable level. You can see that it's starting to level out here. Now, if it starts breaking down and goes down below 50, then we're going to be concerned and say, well, the recession's coming in. At this point, I don't see any recession, but I do see a cooling economy. And you can see from the previous slide, we had all this liquidity had to go somewhere. People were buying and spending. The stock market was exploding. You had all kinds of things going on. People were a little pent-up demand from a recession, and people were out spending. And you can see that. So it's cooling down again, just like the prior liquidity bubble. And I think it's more at a sustainable level. Let me go to my next slide, and let's look at that. Now, Also, we've been talking about the fact that we're probably pretty close to full employment. Now, we have an awful lot of baby boomers like me that have thrown in the towel and said, honey, it's time to stay home and let's go enjoy our golden years. So a lot of baby boomers came out of the economy. A lot of them are no longer working, and that's put a little stress. There's not as many employees. Remember, on a normal day, 10,000 baby boomers retire. Now, in an abnormal day, there's a lot more than that. And in the last couple of years, we've had a lot more baby boomers that have decided to retire, and that has put some stress on our employment. And it looks like we're coming down to a fully employed economy. We talked about the fact that we had thought we were going to get a lot more employees, around 400,000, and the last one came in at 199. So a significant difference, which means that the economy is cooling. It's coming down to, I think, a sustainable level. But of course, if we make any policy mistakes, we have some changes. We're having some supply chain issues. We're having some issues in China. China is shutting down a lot of their production. They're closing down cities, and that may very well bleed over to us. And if it does, then we're going to keep our eyes on it. That could very well cause a more than just a slowdown. We could go into recession. At this point, I don't see a recession. Oh, by the way, I really need your support. We do this, and it's really, really important that if you like our videos and we bring some value to you, that you give us a thumbs up if you like this, because it really helps with the algorithms. And I'm going to have a call to action. If you want to reach me and you are having some concerns about your retirement, or you'd like to make your life a little better, if you'd like to start getting involved in our asset class, which is the real estate investment asset class, we like small single-family homes that are close to your home, or in one of the major markets. You can hire property managers. You're welcome to reach us and brainstorm with us. You're welcome to have your financial advisor reach us, and we'll all do what's best for you and come up with a plan. We're in the real estate business. I've written a couple of books. I'd love your support with that too, and please subscribe. It really, really helps us a lot.